and welcome to Taking Stock, the show where we take stock of the week gone by and prepare you for the one that's coming up next. I'm Surabhi Upadhyay. With me is Ekta Batra, and today is a slightly more special show because it is the last week of 2018 that we are taking stock of. Looking forward, of course, to 2019. Hi, Ekta.
Hi, Surabhi. Yes, absolutely. And joining us on the show to discuss the week on Dalal Street as well as the year on Dalal Street is Co-Chief Investment Officer for Aditya Birla Sun Life, Mahesh Patil. Thank you very much for joining in on the show. But before we come to you, let's in fact take a look at how exactly the markets fared this entire week. Well, Surabhi, it turned out to be a bit of a roller coaster ride considering that we recovered from levels of around 10,500 all the way to almost 10,900.
Yeah, absolutely. You put the finger on it really, Ekta, because volatility has been the new normal, not just for the Indian market, but of course for the US market, which is where we were taking our cues from. So all things all put together, it's not a bad end to the week. For the week, the Nifty managed a 1% gain. The Bank Nifty was up as well. Even the Midcap index managed to put up about a 0.5% show for itself. And towards the end of the week, of course, we saw a lot of flair in the mid-cap universe as well. There was participation from banking largely throughout. Banks also got a bit of a flip up because of the excitement in the PSU space. A lot of talk about the actual quantum of the recapitalization, those figures trickling in for some of the PSU banks. But overall, if we talk about some of the key trends, then on the international arena, volatility and tracking the Dow continues to be the biggest headache of it all, because we saw that big fall on Monday just before the Christmas break and then a 1,000-point rally. So that's the extent of global volatility that our market has had to contend with as well. The one good news, of course, was the decline in crude oil prices. We saw a drop on Brent to sub 50 and then subsequently a rebound to about 53, 54 once again. But anyway, that continued to be a tailwind. The worry factor for the market in terms of our own macros this week was perhaps the fiscal deficit number, because for the year up till November, the deficit figure has already crossed 114% of the full year target. So we are well above the overall targets. And with a lot of talk on farm loan waivers and more measures for the rural economy, Ekta, I guess that's going to be a bit of a watch point. But that didn't really dampen sentiment. Thin volumes throughout the week, especially on Friday. And it was bulls in control for what it's worth, at least for now.
Yes, absolutely. And in fact, Sanjeev Sanyal did mention, talking to Lata Venkatesh of earlier in the week, that, fiscal deficit would probably be met at around 3.3% for FY19. And there could be minor variations, but not a huge variation from that. But nonetheless, a lot of stocks in focus for the week. So, for example, Adani Port, which was up around 7-odd%. Z Entertainment rallied around 6-odd%. There was traction in a couple of these NBFCs, which have been beaten down. So that stock was up around 6-odd%. That's Indiabulls Housing Finance. Tech M was up around 2.6% from the IT space, along with Wipro. And Titan from the consumption space saw traction. On the downside, autos lost out. So watch out for that. Hero Moto, Bajaj Auto, Tata Motors, all of them down for the week. BPCL, IOC lost out despite the lower crude prices. Coal India lost out. JSW Steel was lower, along with Tata Steel as well from the metal space. From the broader markets, Jet rallied and flew away, up around 9-odd%. REC also was higher for the week. We had United Bank and a couple of other PSU banks on recapitalization. So both the Union Bank, for example, was up around 4-odd%. Mid-cap losers included something like an HEG, Max Ventures. Remember, the deal was announced with regards to Max India, but nonetheless, that stock was in focus. Lupin, Vodafone Idea were a couple of stocks which managed to go home with losses on a week-to-date basis.
Okay, well, that's the week gone by. Let's straight away get to our guest on the show. Mahesh Patil is with us in the studios. Mahesh, season's greetings, first of all. Thanks so much for dropping in. It's great to see that, someone apart from us is also working, so we can have a market conversation. But, interesting roller coaster last couple of weeks for this market, and we've managed to continue our outperformance despite these 1,000-point swings in the Dow. As you look forward to 2019 now, do you think this India outperformance is going to sustain?
Yes, you're right. I think India, and if you look at the emerging markets in general, I think are starting to outperform the developed markets, or US in particular. And that's the kind of a larger call, okay, which one is looking forward getting into 2019, with the emerging markets which have seen a huge underperformance vis-a-vis the US, okay, which is the kind of a bellwether for the developed markets, whether that will turn around next year. And there are indications of that, because of the US dollar strength, which was driving this underperformance of emerging markets and the huge capital outflows what we saw in this calendar year. I think US dollar strength is kind of peaked out. And US economic growth also, which was very strong this calendar year, will slow down next year. And with the policy rate increases also won't be as one was expecting to that extent. I think, and also overall emerging markets, if you look at their valuations, are now comparatively lower compared to the historical averages. India is a slight exception. So I think one would expect that the flows into emerging markets should be better relatively going forward. And if any indication is of that, I think in the last 1 month we've seen emerging market ETFs have actually seen inflows. While FI outflows have been there because of other markets, but ETFs, they have seen inflows. So I think that trend could continue, and that should bode well for Indian markets. So I think relatively, I think India markets should do better than, say, the developed markets or US in particular. I think that clearly seems to be the kind of a trend getting into 2019. In absolute term, I think what return it gives, it depends on how the global sentiment is, how risk-off is, how the earnings growth pan out in 2019, which is, mind you, going to be a big year for earnings, because a lot of sectors, we'll talk about that later, but a lot of sectors would see a big rebound in earnings in 2019.
Sure. Mahesh, just taking that point forward with regards to India's outperformance as compared to developed markets, within the emerging market basket, what do you think India's performance would be on a relative basis?
So within emerging markets also, I think we have done better this year. So in fact, India has done fairly well, in fact, even on a dollar basis, because while the rupee depreciated initially and there's been a slight appreciation. So net, if you look at the Nifty alone, I mean, the broader market would probably tell a different story if you look at the other indices like the Midcap index. But the Nifty in absolute terms for this calendar year, we were looking at some of the numbers, has done better even vis-a-vis the other emerging markets, because a lot of the other emerging markets have seen a huge currency depreciation also in the early part of this calendar year, right? And that has led to the dollar returns being not as great. So India would be amongst the top quartile in terms of returns in this calendar year, even vis-a-vis the emerging markets. Though actually India's weightage in the emerging market funds has come down. So FI has actually sold India this year, but probably because the domestic money which was there and strong inflows which continued in this calendar year probably led to the outperformance of India.
That's been the story of 2018, really, if you ask me. The way mutual fund money has absorbed all the FII selling. It's one of the highest FII sell years since 2008, and yet we managed to be positive almost 3% for the year. So, Mahesh, now let's talk about portfolio construct, thoughts for 2019 as we go forward. Is the story going to be the same, private sector financials or consumer, which pretty much dominated this year? Or do you see the tide turning in favor of cyclicals? Because there's a big debate about whether there's a capex recovery and whether this is a sustainable, real capex recovery. What do you think?
So I think some of the sectors which you mentioned, the consumption, the consumer stocks, or the private sector, the retail banks, I think they'll continue to grow. I think earnings growth there will be fairly strong. The valuations there are on the higher side. So the returns there could be probably moderate, but I think the outlook there remains fairly good. Yeah, the question is whether some of the cyclicals which are kind of beaten down and have underperformed in the last 1 year or 2 years, whether they will turn around. And there are initial signs of pickup over there, though very early, I would say. And if you talk about the capital goods sector or the infrastructure sector, the construction companies, in the infrastructure sector, I think the order books have been fairly strong. We've seen good order inflows in this fiscal year. And execution is picking up now. So we've seen that in the last quarter, and that should continue going forward. So I think we expect that sector to do well because the valuations there are also very reasonable. The stock prices have corrected. Most of the stocks are in the mid and small cap in this sector. So I think that should do well because execution will pick up. And normally during election, pre-election, we see a good pickup in execution at the ground level.
So let me just drill that down further. So what kind of companies would you be comfortable holding on or buying now? Are you looking at road players? Or do you think industrial capex is also picking up, so you'd be willing to buy some of those big capital goods?
I think it will initially be the road companies into metro projects, the power, transmission and distribution. Those are the areas where clearly there is growth. I think industrial capex per se is still early days for that, I would say. There are some green shoots in industrial capex in a few sectors, like, for example, steel, fertilizer, in the oil and gas sector. But again, these are not really large capital intensive areas. So I think going forward, I think post-election, is where I think you could see some pickup in capex, because nobody's going to take big capex looking at that uncertainty. And as the capacity utilization levels slowly move up, and we're seeing that happen as demand is picking up, I think capex recovery one could expect that sometime in the latter part of this calendar year. Until that will be very slow and gradual, I would say, yeah.
You mentioned retail banks, Mahesh, but do you think 2019 could be the year of the PSU banks?
I don't know the PSU banks, but clearly this could be the year for the corporate banks. So corporate banks have
Which would include some PSU banks, maybe the larger ones?
Which could include PSU banks, some of them. It could also include the private banks. But corporate banks have gone through the biggest cleanup in terms of, and the worst in terms of the NPA cycle. And incrementally, we are seeing that, not seeing any stress in any new sectors cropping up. So that should help them to, over a period of time. And a lot of the banks have taken upfront provisioning, written off those things. The NCLT resolutions also will lead to some kind of recoveries, what we have seen in some of the large accounts. So that should help. And also the rally in the bonds, right? 10-year bonds should mean that you should see some gains on the bond portfolio, and which should also help in terms of the balance sheet repair. So given the fact that and also the credit growth itself is picking up now. So overall corporate credit growth, which was kind of flattish, we're seeing signs of the pickup, and it's reflecting the overall credit growth, which has been around 13 to 14%. So given all these factors, I think the fact that the NPA is peaking out, the credit cost will start to come down dramatically from next fiscal year onwards, and improvement in the return on assets for the corporate banks would, and again, there is some potential for P re-rating also, because these banks are trading at multiples which are near the long-term average or slightly below that. So a pickup, definitely earnings growth will be very strong.
So corporate private banks or retail private banks?
Corporate,
your favorite? Corporates will be your favorites
yes,
for the next year.
Private banks, yes.
Okay, and do you think that it'll be the year of the NBFCs resurrecting the losses that they saw in 2018, the liquidity issues ironing out?
So NBFCs have kind of bounced back, and at least the stronger ones, right? So I think NBFCs, again, there'll be, again, a clear differentiation over there within the NBFC sector. I mean, companies which have got a strong pedigree and should not have challenges in terms of raising funds. The cost of funds has gone up, the borrowing cost has gone up, and again, there NBFCs which got pricing power and ability to pass it down to the end consumer, they should still be able to do well and protect their margins. So I think overall liquidity is coming back. We have seen rollovers happening, but clearly the growth will slow down for the NBFC space, which were growing very fast. I mean, so the NBFCs were contributing to almost more than 60% of the incremental credit, and some of the companies were growing at around 30, 40, 50% also. I think that growth will moderate down, but post the correction, what we've seen in a lot of the NBFCs and the valuation correction, I think, yeah, some of them, not all, but some of them will do well. The mortgage finance NBFCs, except for one or two guys, would probably face some challenges because the business model itself will face some issues. We'll see some pressure in terms of margins and ROAs over there.
So generally speaking, let's say, I mean, would you stay away from housing finance companies? And when you say some NBFCs might do well, give us a little more color.
So as I said,
what
NBFCs
sort of
with
NBFCs?
A strong parentage, right, and strong liability franchise. And on the asset side, which they are catering to small micro ticket financing, and spaces where the banks are not really very aggressive, right? So they would have pricing power over there and able to pass on any increase in the overall cost of fund, which has happened arguably. I mean, the cost of funds have gone up because NBFCs were tapping on the shorter end of the curve where the rates were lower.
Sure. You know, since we're talking financials in detail, I want to get your sense on how you are reading the insurance business. I mean, still new plays in the market, plenty of excitement. There are already deals happening, you know, whether it's a promoter or a strategic investor selling out to another. But in insurance, are you happy with the growth rates? Would you prefer life or non-life? How are you looking at it?
So in the insurance space, the non-life clearly has been doing much better in terms of growth, and because it's still an underpenetrated market, there are a lot of new opportunities opening up in the non-life space, and which is driving a larger growth for the private players over there. So that segment is clearly doing very well, and we've seen those stocks also do well in this year. The life segment is also, I think, last year was a very good year because After demonetization, we saw a lot of money moving into investment products of life insurance companies, ULIP products, which is seeing a slowdown currently. But the protection side of life is seeing a good growth. And that's where a lot of the margin improvement, we've seen a lot of companies have actually shown margin improvement despite the actual premiums haven't really grown as fast as what it was last year. So that, I think, overall life insurance also, I think, should show a steady secular growth going forward. And it's a good space to look at for long-term investing. And in the life space, we've seen the valuations have also moderated down considerably. If you look at the top 2-3 players, their stock prices are almost equal to what the IPO prices were, even below that. So valuation correction and overall profitability for the life insurance players has improved. And I think growth will continue there at around 14-15%, which is a steady, secular kind of a long-term growth which one can expect.
Mahesh, there's been a stark underperformance coming from auto sectors. For example, Tata Motors has fallen off a cliff this year, down 60% year to date. Do you think that maybe valuations will come back in 2019? Or do you think that maybe there is a structural story of lower valuations that you're talking about when it comes to auto stocks now, the likes of Eicher Motors, for example?
So auto sector, there are different segments to that, right? Tata Motors is different because of the global issues, right? So global, we have seen a slowdown in luxury sales and they have their own problems. So that's a different story altogether. But overall in the auto sector, yeah, clearly there has been some disappointment in the last couple of months, this festive season post that. It's not been as great as one was expecting. And which is a slight surprise because it was starting to do well at the beginning of the financial year. The growth was picking up both in the four-wheelers and the two-wheelers. And there is some kind of a moderation, probably because of the slight increase in interest costs. The fuel price increase initially, but that has now moderated down, so that should help. So I think near term, I think the volume numbers are looking a bit tepid. And we've seen that last month. And probably this month also would be not so great a number over there. But I would say that auto sector don't see a long-term problem over there. I think growth should come back. It's a temporary issue, I guess. And rural economy, if it gains some momentum, and we're seeing a good push on rural. And this year, pre-election, you should see a good push to consumption, right? A lot of spending will happen by the government. And that should help for the sector to revive. So I think barring a short-term hiccup, what we're seeing in this quarter and probably in the next quarter, I think the sector looks well. And there again, the four-wheelers look to be better than the two-wheelers. Because two-wheelers, there is some kind of a pricing competition, which is there. There is more competitive pricing, and that might put some pressure on margins over there.
So four-wheelers maybe still a good bet. So that brings me to the last question, Mahesh. You mentioned the rural push. For you, is that the big operative theme of 2019? And then therefore, what is the best way that you would look at playing it if that is your theme of 2019? If it isn't, then tell us what do you think will be the big theme next year?
So rural push, definitely I think we should see that getting momentum at least during the pre-election period.
And how do you play that then?
Yeah, so but again, as I said, very difficult. I mean, that could be played indirectly actually through consumption, right? So it will lead to consumption, not necessarily high-ticket consumption, but small-ticket consumption in consumer durables. Okay, can be one sector. So overall consumption, one is the consumer staples part, but I think discretionary consumption, I think, and not necessarily the high-ticket, but the small-ticket discretionary consumption, we think that could be one theme to play through. Again, that's again a longer-term theme for us, which we like because in India, with rising per capita income, lower penetration in some of these categories, shift from unorganized to organized, gives a lot of potential for these companies to continue to grow over a longer term. So that's clearly a broader theme, consumer discretionary, consumer durables. I think besides that, I think the broader theme, as you mentioned, in the banking and financial, the corporate banks, I think would be another theme which one would play out. And selectively in the capital good and infrastructure plays, I think those would be the themes which one would look forward to for next calendar year.
All right, Mahesh. On that note, we're going to wrap it up. Thank you very much for joining in and sharing all of your views and a 2019 outlook, and wishing you a very happy New Year as well.
Yeah, Happy New Year to all the viewers. Thank you.
Thanks, Mahesh, for joining in. We'll take a break now, but first let's get in some market opinion we've heard through the week, and when we come back, Ashwini Gujral will be joining in with the technicals for the week to come.
I think that even if you start seeing mildly positive FII flows, I feel that our market can revive, and it could be among the first few markets to get into lifetime highs. Fact is that our markets can surprise on the upside. So I'm looking at 11,000 as an immediate area right now. But I feel if 11,000 gets taken, we have a very good chance of a shot at that space. So I think Indian markets have done very well, and I feel that compared to others, we've actually held out very well.
Market valuations have corrected. I mean, even in a big, large developed market like US, you've seen a massive correction in the last 2 months, and that has made markets much more reasonably valued in most places. And from an investor's point of view, this kind of an environment is clearly superior to what we saw at the start of the year. I would actually view the correction as healthy, because if you have an overvalued market and you're a long-only mutual fund, you had more problems at the start of the year than you have at this point of the time.
We think there is a reasonable amount of risk at this point in time. We would actually protect ourselves. And my sense is the risks are loaded much more into the first half of the year than anything that happens beyond 6 months, quite honestly. So those risks will come from many forms. One, in effect, you have an election where the call is uncertain. You've had a change in the RBI, so you don't exactly know how monetary policy is effectively going to go on from there. And I think the third thing really is that at the end of the day, I don't think there's enough happening in the economy at this point in time for you to get effectively any positive surprises.
Welcome back to Taking Stock. Well, we have Ashwini Gujral joining in with his technical view for next week. Well, we've ended the week very close to that 10,900 mark. Ashwini, do you think that there is enough juice to go long for next week as well?
See, what's happened this week is that the previous week was a down week. And this week we've covered all the losses and closed almost at the previous week's high. Now what that means is that a correction cannot sustain even 4 or 5 days in this market now. So the buying is coming back at higher and higher levels. So I wouldn't be surprised now that there's all kinds of rallies happening in the globe, that next week we get past 11,000 and possibly the bank Nifty also breaks out. And that way, 11,200 and maybe 28,200 on Bank Nifty comes in. So we've carried long positions on Nifty, Bank Nifty stocks, and now it's only a matter of time when that breakout happens.
So more stock specific. On Friday, we saw a lot of stocks coming out and performing. For example, Titan, and so did a couple of OMCs. What does it look like will be the leader probably next week, though volumes might be low?
See, not only this group has been moving, but I tracked the Nifty Next 50. That was up 282 points. That just shows that the broader market is now beginning to participate. So that's a good thing at 10,900, 11,000. The broader markets are participating. That means the market is ready for some action on the upside. I think infrastructure continues to remain the theme. This week also you had GE, T&D, Siemens, Cummins. Also private banks have come back strongly. Yesterday most of them were down 1.5%. Today they are all up as much. So my sense is that there is clear leadership in private banks, Reliance. IT is not going down, which is a big deal. So I think there is good sector rotation. It's not a narrow market.
Okay, so let's talk about immediate Monday then, last trading day of the year. Ashwini, what will you trade?
Yeah, the picks for next week are Titan, which could break out above 1,000 next week if the Nifty breaks out. So that's a buy with a stop of 917, target of 950. Capital goods have shown great participation. So GE, T&D is a buy with a stop of 290, target of 325. And Indigo is showing upside movement. This is a buy with a stop of 1165, target of 1210.
Okay, all right, Ashwini, I'll leave you now to enjoy your weekend. And with that, it is a wrap on this edition of Taking Stock. We will see you bright and early on Monday morning once again. Have a great weekend. Back with you on Monday.